Wealth management is not just for the wealthy. Everyone is entitled to their best retirement possible. Welcome to The Retirement Engineer with Jim Kruzan, your path to a bigger, bolder retirement. Brought to you by Kaydan Wealth Management, a firm that specializes in serving the mobility technology industry. In this podcast, we help you maximize your resources and engineer your best retirement through a process-driven approach so you can get the little things right. Drawing from years of expertise, Jim and his guests will simplify complex wealth management strategies and explore actionable ideas to help you protect your hard-earned wealth and take control of your future. Now, on to the show.
Imagine pouring your hard-earned money into investments only to watch your portfolio underperform due to avoidable mistakes. Today, we're uncovering the top 6 investment blunders that could be holding you back and how to sidestep them. I'm Patrice Sikora, along with your host, Jim Kruzan. So, Jim, let's dive into the first mistake, a lack of knowledge and understanding.
Yeah, first off, let me just explain that these 6 are the more common recurring things that we see in our practice. I suppose if you wanted to Google mistakes people make, there might be anywhere from a dozen or so common mistakes, but these 6 tend to be the ones that when you see serious mistakes that affect wealth creation down the road, these are the ones that typically people stumble on. Yeah. So the first one, knowledge and understanding, really has more to do with what you are buying or what's being sold to you. We're not expecting people to be experts in macroeconomic theory or microeconomic theory. They don't have to analyze a stock, but they should know, hey, what is the intent? What is the purpose of what it is I'm buying? What is the problem that it's supposed to fix? And more importantly, how does it fit in to the rest of the stuff that I'm doing? It's not like, oh, I heard somebody talk about this investment and it sounded really neat. Let me buy some of that too. That's probably not the best way to go about it. And when I'm talking about knowledge and understanding, I'm also referring to understand the cost involved, understand the restrictions that you might have as a result of investing in it. And a lot of these are cost related. You know, what are the transactional costs involved in owning it? What are the internal costs that I don't see, but are certainly impacting long-term wealth creation? What are the surrender charges or liquidity restrictions that would cause me to not have access to this money at the time that I might need it most? And also, as a huge cost, what are the tax consequences of owning something like this? And as I said before, how does it play with the rest of the stuff? Is it helping or hindering the overall investment strategy by having something like this in a portfolio? And there are a lot of examples I could suggest over 42 years of doing this. The one that was so blatant happened not that long ago. And it was kind of a twofer, meaning I'm not quite sure, but I think the client clearly didn't understand what they owned. And now upon further review, I'm pretty certain the advisor who sold it really didn't have a good idea what it was all about as well. We had a client who decided to invest in an equity indexed annuity, which is perfectly fine. And those things typically have a fairly long-term surrender charge. And they generally don't perform really well in a good market. The purpose is, hey, we're not going to lose anything in a bad market, and we're going to get just some kind of a return in the up year. They're kind of sold like, hey, you're going to get market-like returns, which is never, ever, ever the case. So this thing was sold, we'll call it 18 months before, and it just happened that the last 12 months was a very, very strong market. So the agent who sold the client this type of product previously came back and said, you know what, I've been reviewing the performance of this thing and it just isn't performing the way I would have hoped it to. So let's plan on getting out of it and buy something new, which would have been a replacement, another annuity of similar ilk. Now, a couple problems with that is the client had no idea about the cost involved or surrender charges. And there would have been a sizable charge, 6, 7, 8% of
Oh
portfolio
my.
value,
My.
which is a really huge hole to dig out of if it's just a charge alone. And second, at the end of the day, the investment did exactly what it was intended to do. It was never going to get a really terrific rate of return. That in and of itself could be a problem in terms of long-term growth, but in terms of performing the way it did in a somewhat buoyant market, it did exactly as expected. So here's a case where the client really didn't have a clear understanding. I'm not quite sure whether the agent did as well. And it would have been a horrible mistake. Thankfully, her son said, hey, why don't you talk to Jim and his team and just get another opinion on this? And when we looked at it, we said, look, with those surrender charges that you have, the best thing you can do is stay put. We'll figure out how to manipulate the rest of the portfolio to kind of offset this thing that you've got. But by all means, don't get out of it the way that it was suggested. So understanding how these things work is really, really, really important.
Isn't that one of the reasons you go to an agent, though? They
You
supposedly
would hope so.
understand what they have.
You would hope so. There's so many different people in our industry performing in different ways, right? Some are selling product, some are providing advice, some take a collaborative, holistic approach. Others are really out to find folks that they can sell a certain product to. And when you're talking to people like that, I'm not saying that that's wrong. There's a purpose place for everyone. Their approach is sort of like, look, I've got a hammer and everybody looks like a nail, and I'm going to kind of sell this thing to as many people as I can, or find a reason to recommend and rationalize this type of a purchase. Whereas somebody else who may have a greater menu of solutions might say, there are better ways to get to where you want to go without having these problems of liquidity, et cetera, et cetera. So you're absolutely right. Best thing to do is, I know it sounds self-serving, but best thing to do is partner with a trusted advisor.
All right, the next point is something we've actually seen quite a bit the last few years. Meme stocks chasing hot markets, going for those returns. Immediately, the whole GameStop debacle comes to mind. And now more recently, NVIDIA has been, everybody wants to get in. Is it too late? Who knows?
Yeah.
But you're just chasing things.
Right. Well, I suppose everything in moderation, right? If the idea is you understand it for what it is, it's some way, shape, or form of organized gambling, and you have a certain amount of money that you're willing to lose or gamble with that will have no bearing on your financial outcome, then have at it. It might be fun. It might create some opportunity to have conversations with people you wouldn't normally have conversations with. But if the idea is, I'm feeling really upset and mad because I'm missing out on all these great returns, and these returns are coming from an environment that looks to be quite a bit of a bubble, and the only defense is, well, you don't understand, it's different this time. Let me clue you in on a little secret. It's never different this time. It always tends to end poorly. And it's not like these bubbles that we can talk about today are kind of new events. You can go back in history and talk about the Dutch tulip bulb,
Tulip bulb,
right? And that was the early 1600s. I can remember back in the mid 80s, comic books, mint condition comic books in sealed plastic cases were going through the roof. People were paying untold amounts of money for those things. I was still in college when there was a huge silver bubble in the 1980s, and people were buying ounces of silver for prices that we've never seen again. And that's 45 years ago, as if it was different this time. And then obviously cryptos had a couple of bubbles back just before the financial crisis. Was that whole real estate bubble, lots of speculation. Florida real estate's going through the roof. Las Vegas and Phoenix real estate is going through the roof. And then there was a horrible bubble. And then all the real smart money stepped in and bought these things at fractions of what people had paid for them previously. BlackRock, a lot of large hedge funds. So this all falls into the category of greed. You never want to invest hard-earned assets. You never want to invest what I would call meaningful assets because of greed. That never works well. And today with generative AI has been around for 30 years. It is well documented. Siri, robotic controllers, they all have used AI for decades. It's this whole idea of large language learning, generative AI, which is all the craze. Fact of the matter is, very few companies are posting any kind of earnings as a result of the investment today. Much like back in the early 2000s, late 90s, all the money that was pumped into routers and servers to have access to the internet, to be able to then articulate an internet-based marketing strategy. What eventually happened is the economy cooled down, because it always does, and companies had to cut back dramatically on their spend. That would be large chip systems for AI, as it was servers and routers back then. And then all of a sudden we wake up to the fact that, oh my goodness, NVIDIA perhaps, or maybe another company, has now sold every bit as many chips as anybody is ever going to need the next several years, because everybody is cutting back because earnings are getting impacted as a result of an economic slowdown. And then these stocks start to tumble. Back in the day, 25 years ago, Cisco Systems was the market darling. Cisco Systems, which is a great company, and it's a wonderful company today. But back then, it was the darling. It was the NVIDIA of its day. And it sold routers and servers. It sold all the things you need to connect to the internet, and everybody wanted to connect to the internet. Until the recession finally came and companies started to cut back on their internet spending strategy. Why? Because it was a long-term investment. It wasn't delivering any earnings, but it was creating a lot of expenses. And then all of a sudden, Cisco realizes, geez, we sold everybody gobs of these things that they have in warehouses because they bought in advance, thinking that when they need it, there won't be the product because the demand is going to continue to grow on and on and on. Well, I'll tell you, split adjusted, if you bought Cisco April of 2000, over 24 years ago, you're still waiting to make a penny on it.
Ooh, that hurts.
Microsoft, huge darling today, incredibly strong investment. But if you got over your skis, got compelled by greed and missing out, and bought Microsoft in and around the same time, it took over a dozen years for Microsoft to get back to what you paid for it. And that's just what happens when you pay 30, 35 times earnings or more. It sounds great at the time. The stock continues to go up. But at some point, these things don't grow to the trees or to the sky or the sun or whatever. And eventually they come down, and they come down hard. And that's not to say that NVIDIA isn't a great company, nor will it be a great company. But AI, or generative AI, is maybe not quite ready for prime time yet. And much like the internet in 2000 wasn't quite ready for prime time. And much like the internet, I'm sure AI will live up to every bit of its hype, but it's going to take more than a quarter or two. And as a result, that's where the problem is. So never invest for greed. You want to speculate for greed? You want to have some fun, do that instead of placing a bet on a phone app? Sure, that makes sense, but not with serious dollars that you have to call on in the future.
And don't look at the short term.
Not at all. It's all about the long term. It's all about, what am I doing today, and what impact does what I'm doing today have on my wealth creation a decade or more down the road? And that's where we get these imbalances. We may be a bit more defensive today, and we're missing out a bit. But in the longer term, it's probably the exact right thing to do. We just don't see it as that. Much like, speculating today, that might be fun in the short term, but the distribution of returns is certainly asymmetrical, probably far more downside risk than upside. So I'll just leave it at that. Along the lines of investing, another thing that we see a lot, again, having huge ramifications down the road, much less in the immediate or near term, is not paying attention to location. And what I mean by that isn't, well, where's the asset sitting today? Are they sitting at Kaydan Wealth? Are they sitting at Chase? Are they at Vanguard or Fidelity? But rather, are they in a deferred account? Are they in a qualified deferred account? Are they in a tax-free account? And what kind of assets are we holding there? We're a big fan of triangulation. We've said that before. We like to, as clients are advancing toward retirement, make sure that we have buckets, pools of assets that might be taxable if we access them, might be tax-free, or might come back to us in a preferred tax situation. So location is really important. And we see often people making investments or making adjustments to their portfolio strategy without serious consideration of where they're held and the type of account they're in. As an example, with the exception of maybe some retirement income options, as a general bit of advice, it's usually not a very good idea to put a tax-deferred annuity inside a tax-deferred IRA. If the idea is all I'm doing is putting money in a variable annuity and I'm buying a series of mutual funds, you could buy the same series of mutual funds directly inside the IRA. You'd have the same degree of tax deferral, but you're going to eliminate all of those internal fees and cost, mortality and expense fees, et cetera, that are unique to the annuity itself. And it's important to take that into consideration. In addition to that, understand kind of the purpose for the account you have. If we were to consider, reasons to invest or things to consider when investing, we could say, taxes are certainly one. Asset growth, are these assets to grow over time? I'm not planning on using now. Or in the case of legacy, I may never consider using them at all. And then what about cash flow generation? Am I expecting to use these assets to generate some degree of cash flow? And how do I plan on generating that cash flow? Is it interest? Is it dividend? Is it harvesting some capital gains along the way? Understanding the purpose of the account helps quite a bit because that also gives you a better sense for what type of assets we might want to hold. As an example, if I've got a client who's 75 years old and has has some money in Roth IRAs, and at this point, we've never had to use them. They're already required to take a large distribution from their IRA, which is generating more cash flow than they really need. The reality of it is this Roth IRA may very well be legacy. They're never going to use it. It's going to get passed on to the kids. So instead of investing it and allocating it as we would any 75-year-old, consider that to be a bit more conservative allocation for obvious reasons. Maybe it's best to consider allocating that for its intent, which is, hey, the kids are going to get this. And if the kids are in their 40s today and mom and dad might live another 15 years, why aren't we investing that for growth? And we should own the growthier things in that tax-free bucket than somewhere else. Mm-hmm. If we also have a situation, which I would call legacy, and we have money that's sitting in a bank account and it's earning interest today, for 13 years, we had 0% interest. So money in the bank was never a tax problem. It never threw off taxable income, but now it does. And there might be somebody who happens upon you who is in the business to sell annuities. And they might say, well, if we took this money out of the bank and parked it in this annuity, you can get a rate of return for the next year of X. And by the way, you won't pay any taxes because it's all deferred. And you might think, wow, this is great. Immediately, I'm solving a problem, whether it's a legitimate problem or not. But if the real purpose of this money is then legacy, it many cases is kind of one of the worst things you could possibly do. For example, all that money that's now sitting in the annuity, if you needed to use any of it, it's going to come back to you as certainly taxable income. If that was money that was in the market that's now in an annuity, that would have come back to you as qualified dividends, which would have been in a lower bracket, lower tax treatment than ordinary taxable income. Had there been a gain, it would have been long-term capital gains as opposed to ordinary taxable income, as it is in an annuity. And more importantly, when you pass, the kids inherit the annuity with all that tax buildup that they will have to pay. It's a taxable event for them. How they treat it over how many years remains to be seen. Whereas if that were sitting in the bank account, or if that was sitting in the market in growth-oriented mutual funds, there'd be a stepped-up cost basis, and the legacy end of this would inherit that money with absolutely no tax consequence at all. So here, in terms of wealth growth and the ability to distribute greater wealth to your heirs, which in this case we're assuming is a goal, you're denying that significantly. You're really reducing the potential outcome by not taking into consideration the best location for those particular types of assets. So that's something we see way too often. Moving on to the next point, in this case, it's 0.4, 4 out of 6. It's another mistake. But whereas chasing hot markets was driven somewhat by greed, this is making investment decisions simply based on fear alone. And we see that in way too many cases as well. And unfortunately, the mistake is you generally get really concerned about risk after the big correction, after the huge drop, after all the animals have already escaped the barn. Now you're closing the barn door. And it has a huge impact on wealth creation. As after big drops, there's generally incredibly strong recoveries. Not to pick on any particular type of product, but just as a great example of this, fixed indexed annuities, you generally see a huge upsurge in sales after a sizable drop in the market. 2022, the market drops 25%. 2023, everybody's piling into these because they saw their portfolio go down 25%. All the while, the market's now recovering. And then they get their return, which is 4 or 5% versus something significantly larger. And this goes on and on and on. I can remember a number of years ago, I gave a live seminar, and a woman came up after the seminar. And she said, yeah, I might like to schedule an appointment. I'd like you to take a look at a couple of things. So we chatted for a few minutes, and her big concern was she lost a tremendous amount of money in 2000, 2001, 2002, the 2001 recession. And if you remember back those 3 years, part of it was the dot-com, then we moved into the recession. Yeah. But effectively, the S&P 500 was cut in half. And she ended up going to another seminar and was sold this idea that if you go into this type of an investment product, if the market goes down, you won't go down, but if the market goes up, you'll participate to some extent. So roll ahead, and we're having this discussion in 2007, essentially 6-7 years from that bottom. And the market had already not only recovered everything it lost, but it also created a bit of a premium. It was also up in addition to that. And yet she is still down substantially 7 years later because she didn't enjoy anywhere near the recovery, because she was in a product now that was giving her at best 3 to 4%. So right. After losing 50%, then earning the next 7 years, 3 to 4, do the math. And she was being advised to get out of that annuity and now go into a different annuity that would then invest in variable mutual funds. Like, okay, now we turn the spigot back on. And that's just not the way to invest. That's different than being cautious leading into what potentially could be a correction, as opposed to a knee-jerk reaction based on a sizable drop in capital. And that happens way too often. And there are a number of products that are out there that offer this sense of stability and downside protection, or the ability to see some co-sharing of downside risk. Without going into a lot of detail, certain structured notes, certain types of annuities, in fact, even certain types of ETFs might offer that. And generally, you see an upsurge in interest in those after a big drop. But then the forward-looking return assumptions generally aren't all that great thereafter. So keep that in mind, especially when considering your overall plan and what kind of a rate of return do you need to achieve long term. You might miss that return 1 or 2 years, but you go into a product like that, you might find many years in the future you're still lagging well behind. So keep that in mind.
Why do you think people do this so often, struggle with emotions, and they're trying to time the market?
Yeah, it's I wouldn't even call it market timing. It's more of a emotional knee-jerk reaction. And I think it has a bit to do with behavioral science, recency biases. If the market dropped a ton, you're going to expect or fear that it's going to continue to drop. People play these weird math games, like, wow, the account dropped 25%. Oh my God, in 3 years, I'll be wiped out. I won't have anything. It doesn't typically go to zero, but you also have to have some common knowledge of kind of where we are in the kind of the investment cycle. And if you're not willing to do that, then again, this sounds self-serving, but partner up with some advisor who has the experience and the capability to work with you collaboratively and kind of guide you through this. Somebody to bounce a couple of ideas off of, as opposed to just you're out there on your own. This is kind of feeding in and it's becoming really a problem. And then you react to it, usually emotionally, which is generally not the best approach to long-term investing.
What's your next point here? I see risk tolerance in there.
Yeah, this is one of my favorites because it point 5 is personal wealth cycle and risk tolerance, or what I should say is personal understanding where you are on your personal wealth cycle, where you are in your journey toward wealth, and what that means from the standpoint of loss recovery. There are a lot of things that play into this. I could talk for hours on this topic alone. There's a huge difference in being in an accumulation phase versus being in a decumulation phase and starting to turn the spigot on and enjoy your life savings. When you're in the accumulation phase and you're putting money away and you're saving through a corporate sponsored plan and your employer is participating as well, you can afford to take on a whole lot more risk. First, you don't need any of the money. You're using your salary to support your lifestyle. And the more the market drops, the cheaper the shares are you're buying because you have a new influx of capital going in. That's completely different on the decumulation side. It's just the opposite. And you want to get into a big hole really quickly, you take money out and suffer significant losses on the way down because there's nobody else buying in for you on the way down. You've got to have the dry capital. It also has a lot to do with the arithmetic of a loss. A 50% drop requires 100% recovery to get back to where you were. If the market simply drops 35%, it's got to go up over 50, like 54, to get back. So the upside climb is always a whole lot more. And then if we look at this thing in conjunction with recessions and recoveries, it takes, frankly, much longer to recover when you're decumulating. When you're taking money out of the account regularly every year, it takes longer to get back. As an example, when we look at the '07, the '00 crash,
Mm-hmm.
it took until about mid-year '07 for the S&P to get back to where it was. That was a long period of time. And if you were retired and spending that money out, you never got back, because shortly thereafter, we went into the recession of '08.
That's right.
And the thing that I try to get across is this is hard-earned money. You have certain bucket lists of things you'd like to do, certain experiences. And the investment community, Wall Street, looks at things in a test lab. What's the best in terms of long-term return? Buy and hold forever. Well, that doesn't work when you're sitting out there drawing from the portfolio, living with your emotions daily. And if you're suffering a big drop and it takes years to recover and years more to recover because you're decumulating, it's going to weigh on your thoughts about things you want to do. And inevitably, it's going to deny you the retirement you could have had somebody paid more attention to the downside risk and tried to avert these big drops that we see. So maybe it doesn't take nearly as long to recover. Maybe you're back to spending, back to thinking about experiences and things you'd like to have. I find this to be an interesting area of study. I think it's so relevant to retirees today as baby boomers, thousands are retiring every hour, and nobody has spent really any amount of time really educating on this difference. When you're a foundation builder and starting to build assets and decades away from retirement, all of this discussion about downside risk, you really don't need to have. But as you're getting closer, it gets a lot trickier. We need to have the downside risk protection. But at the same time, we can't deny ourselves the long-term growth as well. So how do you get both? And it's very, very difficult to do that. So we find way too many people are way too aggressive much later into retirement. And that becomes a huge problem. So knowing where you are and kind of what that risk tolerance looks like is really important.
Well, how at Kaydan Wealth do you assess someone's risk tolerance?
Yeah, well, there's a couple tools. We use a couple of outside vendors that will allow a potential client to kind of walk through a series of questions so we get a better sense for kind of what their tolerance is. And at that point, that's just a place to start a conversation from. Mm-hmm. It is not the end all be all, nor do we say, oh, you scored an X number, and because of that, this is the portfolio you need. There's a huge difference in risk tolerance and risk capacity, right? Mm-hmm. Somebody who's quite young might have the tolerance. Oh yeah, let's roll the dice, but they don't really have the capacity because they don't have the accumulated wealth. Conversely, somebody who might have way more wealth than the retirement plan calls for, they may have huge amounts of capacity. They could lose quite a bit, and it won't affect their retirement one iota. But they still, stomach-wise, might have a very low tolerance. Unfortunately, many of our clients, since we work with a lot of engineers, good wage, great savers, they have enough, and they can have a terrific retirement if things don't get screwed up. And when you start running retirement analyses and you look at probability of success, what we also do is we run the same analysis, assuming in the very first few years of retirement, we incur a sizable drop in capital. We call that a bear market test. And what we're looking at then is what is the probability of success at that point? And if it's still really high, very workable, very doable, fine. But in many cases, it isn't. You can have somebody who's 90+% probable if everything works out according to plan, but you bake in a 36% drop in the first couple of years, and now they're in their mid 50s or low 60s, not acceptable at all. Mm-hmm. In which case, we've got to bring to the table other strategies that can provide some means of downside protection, still keeping focused on kind of long-term market-like rates of return. Let's finish this off with point 6. And I call this ignoring markets and economic risk. There are periods of time, and I would suggest not unlike what we see today, where it's like everything is just fine and dandy, and everything is going to continue to just grow and prosper, and look at how well the market's doing, ergo the economy is doing well as well. Understand a little bit about economic cycles. Every expansion has a recession. Every recession leads to an expansion. And if we understand that, we can then position not after the event, after the drop, but defensively as the data continues to weaken. And that can help potentially avoid some of that downside. Or more importantly, when the economic winds are sort of at our back and the data is really looking quite strong, it might give us the opportunity to get out of our comfort zone a little bit and extend the amount of equity and growth opportunities the portfolio has as well. So over a full business cycle, we're attempting to generally outperform by not losing quite as much, by taking advantage of stronger economic trends. Most people are just oblivious to that. Right now, the last year or so, we've dealt with FOMO, the fear of missing out, in spite of where markets are and valuations are. We dealt with YOLO, you only live once. All these things cycle, all these things somewhat come to an end. So whether you have an interest in understanding that, make sure that your advisor does. And I'm willing to bet upon closer review, there are an awful lot of advisors who just don't worry about it because they're still being taught that it's all about long-term growth and time in the market, and the longer you're in, the better off you are. Well, that's true unless you're trying to create a lifestyle and cash flow from this money at some point in time along the way. So that's an area that I find we need to educate and sometimes re-educate folks on. Look, cycles don't go away. You can't wish a recession away. They're healthy, they're organic, they can create huge opportunities, but you better understand that they may very well come along every once in a while. What I find is when we got into the recession in 2001, or the recession in 2008, which really turned out to be 2007, and the market eventually crumbled, everybody was surprised. Like, whoa, where did this come from? Well, the data had been suggesting it for quite a long time. Had anybody paid attention to it? And you might have missed out on some of that heartache. So I'll try to keep that in mind as well.
That is a lot of great stuff in there, Jim, really. So investing wisely, it requires knowledge, patience, and discipline. No one size fits all, no solution there. But by steering clear of the mistakes that Jim discussed today, you can pave the way for long-term success. Remember, the most valuable investment is in your own financial education. And we hope this episode has boosted your confidence in making informed investment decisions. Please be sure to subscribe to the Retirement Engineer podcast so you don't miss future episodes, and follow @Kaydan Wealth on social. Let us know what you think in the comments. Please share topics you'd like us to discuss in future episodes too. Following and sharing this podcast helps our small show make a larger impact.
Thank you for listening to The Retirement Engineer with Jim Kruzan. Click the follow button to be notified when new episodes become available. Visit our website at www.kaydanwealth.com or give us a call at 800-638-6900. The information covered and posted represents the views and opinions of Jim Kruzan and this episode's guests, not necessarily those of Kaydan Wealth Management. The content has been made available for informational and educational purposes only. The content is not intended to be a substitute for professional investing advice. Always seek the advice of your financial advisor or other qualified financial service provider with any questions you may have regarding your investment planning.